Thank you so much for being back with us. We had a lot of important economic data this week. We got the first quarter GDP numbers, we got personal spending, we got ECI. What was most important for you?
David, I've been pointing to the ECI number because I think the labor market is the key to the inflation process, because it only comes quarterly, because it's the best of the numbers for measuring wage inflation, because it includes benefits and adjusts for changes in the composition of the labor force. And that number was pretty strong. That number's running at about 4.8% now, both on an annual basis and a quarterly basis. There's not really evidence that it is decelerating. The revision for last quarter was a little bit upwards, and 4.8% labor cost inflation just does not go with 2% underlying inflation. So I think we've got a bit of a stagflationary problem developing, where we have a base inflation that's well above target. And as I've been saying for the last year and a half, I don't think that's going to get back to target without a meaningful slowdown in the economy. That doesn't mean the Fed's objective should be to induce a slowdown, but if the Fed does what's necessary to contain inflation, I think a slowdown is likely to come along, and the odds on that happening sometime in the next 12 months, I think, are pretty good, perhaps 70%. So I think we're not looking at an easy situation facing the Fed. Given these numbers, I think it's pretty clear that the Fed has to go ahead and move rates in May. Given the emerging credit problems, I think June is very much an open question. So what I hope we'll see from the Fed is a move upwards by 25 basis points in May, followed by a commitment to monitoring both the activity and inflation figures on one hand, and the credit flow issues, which are leading of the economy, on the other.
So, Larry, there was a thought, not a hope, but a thought that perhaps some of the difficulties we had at Silicon Valley Bank, then Signature Bank, and now First Republic Bank might slow down the economy on its own so the Fed wouldn't have to go as far. We thought maybe these were behind us. We now still have the issues that lurked up with First Republic. What do you make of the way that's being handled as opposed to the way Silicon Valley Bank was handled?
Let me just say first, David, that I am very connected to people all over the financial sector, but I have no specific relationship of any kind that I know of with First Republic Bank. I'm surprised and disappointed that this situation has continued to linger as long as it has, with the bank stock down 95% and various other credit indicia of it in a problematic direction. Look, the big banks and the government both have a strong stake in this situation being contained and resolved. The big banks have deposits in First Republic Bank in significant quantity. They have a huge stake in the financial system staying stable.
Larry, let's take a bit of a longer view here now about where we're headed globally with our economy. We had Jake Sullivan, the National Security Advisor, give remarks at the Brookings Institution this week, where he laid out what I took to be sort of a framework under the Biden administration where he wants to go with economic policy. What did you make of that speech?
Jake is a very thoughtful leader, and it's probably the most carefully, intellectually developed exposition of the administration's philosophy that we have had to date. And certainly he's right that the world has changed. He's right that China represents a new kind of challenge. He's right to emphasize, after what we've seen in Europe with oil, other things, the importance of resilience. But I was disappointed that the speech did not emphasize the central importance of importing low-priced goods. That is a substantial part of what determines the living standards of Americans. That is a substantial part of what determines the competitiveness of American producers. For example, we have 60,000 people working in the steel industry and 6 million people working in industries that use steel. So when we raise the price of steel, we are hurting people. The Peterson Institute estimated some time ago that trade reduced costs for consumers by more than $1 trillion. And if we had removed our tariffs on other measures against China, it would have added 2% to people's real incomes by reducing inflation pressure. I think that the administration is much too quick to move to industrial policy strategies on grounds of resilience. Let me give you 2 examples. The Jones Act was the resilience policy of the 1920s. Let's have all our shipping be U.S. carriers. That's made the price of heating oil considerably higher in New England all year. That screwed up our efforts to help Puerto Rico after the hurricane because we didn't have adequate supplies. We had a major infant formula problem in this country. That was related to Buy American policies that meant we couldn't turn quickly to European supply chains. So, of course, we're all for resilience. We're all for strong U.S. producers and strong U.S. businesses. But what I find missing in the approach is helping consumers, which after all is the middle class and is central to how people feel they're doing, recognizing the importance of cooperation in producing a more prosperous general global economy that works to our benefit, and the United States maintaining its commitment to other countries, which we have not done in the trade area for quite some time.
Larry, let's leave our audience on Wall Street here with a quick round of long, short, whether you're long or short certain issues and certain people. Let's start with President Biden's launch of his new re-election campaign. It happened this week. Are you long or short on it?
I'm long. I think that the administration's got a lot that it can run on, and frankly, its opposition is in very substantial disarray.
What about the head of the Bank of Japan, Mr. Ueda? He had his first meeting this week and surprised some people about sort of putting off ultimate decisions about yield curve control. Are you long or short on his premiere?
I think he's a cagey and shrewd guy. Any kind of peg, whether it's an exchange rate or an interest rate, is a hotel that's much easier to check into than to check out of. And I think by setting forth that study mechanism, he is beginning a process of orchestrating leaving a peg that probably has outlived its purpose.
And finally, we talk about the Fed a lot. We don't talk about Fed security very much. This week we had this remarkable incident where apparently some people who were apparently Russian purported to be President Zelensky of Ukraine and got Jay Powell, the chair of the Fed, on the phone and had a fairly detailed discussion with him. You long or short on security at the Federal Reserve?
Oh, I'm short looking backwards and I'm long looking forward, because I'm sure there's going to be a pretty thorough review of how that could have happened that's determined to make sure that doesn't happen again. That's kind of an embarrassing moment. If there's any institution in the United States we want to be unconnable, I would suggest that it's the Fed. But there are a lot of very dedicated people there, and I'm sure they'll get it fixed.